Hi, I'm John Crypto. Get ready for some scary numbers. Not only are they shocking, but they're also a crime scene for your money. In January 2025, silver started off quietly, trading for less than $30 an ounce and moving slowly as if nothing was happening. Then, out of nowhere, it shot up to $121 per ounce, which was 4 times what it had been at its lowest point. It dropped to 64 taels in just one day, before retail traders could even blink. That's not a mistake. 121 to 64 taels in 24 hours, losing gains that took months to build up. And here's the kicker. Even though there was a lot of death and destruction, retail traders still put $430 million into SLV, the biggest silver ETF, in an effort to chase the dream. On January 30th, $100 million left, which was the biggest loss in silver history in one day. Now put the pieces together. The mainstream media screams, "The silver bubble bursts. Retail traders are burning." They make it sound like a bunch of amateurs are controlling the market like a crazy mob. Headlines love drama, and panic in stores is a great way to get people to click. But what is the truth? The disorder was planned. The terror wasn't random, it was a trap. Whales, institutions, and funds that weren't on the radar were discreetly buying actual silver while individual investors lost money because they thought they were in charge. They call it volatility, but we call it manipulation. The problem is that SLV and other ETFs are just paper promises, not real silver. They make it look like the market is full by creating fake liquidity and phantom flows, even though COMEX and Shanghai vaults have record low inventories. People think that the crash is a sign to sell. At the same time, the smart money is quietly buying bars and coins for pennies on the dollar, using the chaos to turn paper into real things before the next move blows up. When retail panic sets in, forced liquidation happens, and margin calls go via weak hands. But the underlying accumulation never stops. Take a look at the volumes. Open interest on COMEX futures rose sharply, even as prices fell, which is a clear evidence that the large players were buying, not selling. The difference between spot and futures prices tells the story. COMEX futures prices fell, but Shanghai premiums rose $5 to $7 above NY prices, showing that demand is still strong in the East. This isn't simply a drop, it's a precursor, a huge silent buildup that no headline will touch. Retail falls right into the trap of margin calls and hype here. People are buying paper ETFs like silver is a lottery ticket and chasing dips with a lot of money. They're entering a market that is set up to work against them, while the smart money stays out of the spotlight and uses ETF redemption procedures to make money. They acquire real silver for less than it's worth, cash in the paper, and quietly stack it up where regulators and retail panic can't get to it. Now imagine being a retail trader and seeing $121 peaks turn into $64 overnight. More forced liquidation happens when people panic sell. Headlines scream disaster. Fear spreads like wildfire on social media, but even if everyone is yelling, the smart money is doing exactly what they said they would do months ago. They use fear as fuel, upheaval as an opportunity, and retail as collateral damage. And here's something the news never tells you. This isn't just ups and downs. This isn't the market acting normal. This is planned manipulation. ETFs and futures are like invisibility cloaks that hide the real story. Silver is being stored like a strategic reserve and is quietly leaving COMEX and Shanghai vaults. While stores are burning, the unseen hands keep getting more. Here's the kicker for you, the viewer. Do you think this price movement is normal? The $121 peak, the $64 drop, and the $430 million in retail inflows are just the beginning. Wait till you see the physical supply drain. The east-west flows silently transporting tons of silver from US warehouses to Asian vaults, and the way whales use this to set up the next impossible move. Once that happens, the price doesn't just move, it blows up. And that's where part 2 begins. The real crime scene, which includes the inventory drain, the leverage trap, and the bad guys' sneaky moves that the media won't tell you about. Retail is heading into a perfect storm without knowing it, and by the time most people do, it will be too late. When that happens, the price doesn't just go up, it goes up quickly. But if you think the volatility we just saw was the main event, Just wait until you see the crime scene behind the numbers. This is where silver isn't just bought and sold. It's also manipulated, designed, and even disappears right in front of you. Here's the kicker. COMEX warehouses are losing silver. The amount of available inventory has dropped 20 to 30% so far this year, and it is getting closer to multi-year lows. Stacks that should be backing futures contracts are disappearing quicker than anyone outside the inner circle knows. Shanghai is screaming the truth on the other side of the world. Premiums have jumped $5, $7 above NY prices, which means that a lot of real silver is moving east. What does that mean? Asia is buying up every ounce that leaves US vaults, which is causing a real supply bottleneck while paper markets act like everything is fine. Futures can't make things disappear like they do in real life. ETFs and COMEX contracts are only illusions. The metal is actually leaving the nation, and retail is left with contracts, not silver. Now pay attention to the trap of leverage. There are more than 3 times as many paper silver futures, ETFs, and swaps as there are real silver. That means the system is based on promises, not on metal. When people panic, forced liquidations go up, red days wipe out retail accounts, and margin calls crush anyone who bought at the top of the frenzy. But wise money doesn't worry about it in the background. They're using every ETF redemption method to turn paper claims into real bars that are stored in secret vaults. People in stores think they're buying silver, but they're really just adding to the whale's collection. When it comes to whales, the villain's moves are small but huge. BlackRock, JP Morgan, and other big banks are secretly buying up real silver without anyone noticing. They don't say anything. No press release, no hype. Just bar after bar going into separate accounts, subtly changing the balance of supply. At the same time, the Fed keeps yields low on purpose, making it easy for big companies to borrow money cheaply. Because borrowing rates are so low, these banks can stock up on a lot of silver while individual investors try to make quick money. This is where the bait and switch happens. Prices drop, headlines scream, silver bubble bursts, panic selling starts, and individual investors get out of ETFs, thinking they are saving their losses. But what about the wise money? They are trading in SLV and other ETFs for real silver at a price that is much lower than what it is worth. The system is rigged. Panic is the gasoline, accumulation is the engine, and retail is the collateral damage. History always repeats itself. Do you remember 2008? While the market was falling apart, banks surreptitiously bought up gold and silver. Or the 2020 FTX-style panic, when regular investors lost all their money in a flash while whales discreetly got ready for the market to bounce back. The most recent swings in silver are following the same pattern. Public markets are in disarray, secret vaults are quietly building up, and wealth is moving from the many to the few without anybody seeing it. Here's the big question. Why would these big companies risk a top of $121 per ounce? Why can ordinary traders put in hundreds of millions of dollars during a crash? The answer is to the east. While Western markets are in a panic and bleeding, Shanghai and other Asian markets are discreetly stockpiling actual silver, which is driving up premiums. There is a narrative that no US news story will cover about ETF inflows, vault withdrawals, and paper-to-physical conversions. This isn't guesswork, it's a plan. A huge amount of goods is being moved to the east to make up for every loss in retail. Now picture this. COMEX inventories disappear, futures contracts fall, ETF redemptions rise sharply, and Shanghai premiums rise sharply. On red days, you have retail traders stuck in leveraged positions, thinking they're getting a good bargain. In the meantime, big institutional investors are quietly moving real metal across borders, anticipating that the next move will open up the market. That is the crime scene, public disorder hiding private gain. And the change is hard. The West is losing paper and feelings, while the East quietly stores lots of silver, which changes the supply in a big way. When futures and ETFs eventually catch up to real-world shortages, prices won't just go up. They'll go up so much that you won't believe it. But that's just the beginning. What happens when central bank policy, geopolitical pressure, and flows between the East and West all come together? That's when part 3 starts. The secret buyers, the supply chain struggle, and the quiet attack on the US currency. You've seen stores go crazy, vaults that are empty, and paper beat metal. But you haven't seen how the East's stacking will change the global silver markets and create the conditions for a possible historic squeeze. When that domino falls, all of the leveraged positions in the West will feel it. While the West loses paper contracts, the East quietly stacks physical silver, even bars that the US media won't talk about. Here's the kicker. Shanghai prices are now 5,700 higher than New York pricing, which shows that Asia is still buying. Every ounce that leaves the COMEX vaults goes to Hong Kong, Singapore, and Shanghai, presenting a classic arbitrage opportunity that only insiders can take advantage of. While retail in the West freaks out on red days, ETF inflows are like a crypto-style craze. SLV goes down on paper, but SHFE inflows go up, silently moving wealth to the East. Now put the pieces together. Silver isn't just moving because of industrial need. There is a secret buyer that most investors can't see. Some unnamed central banks are covertly adding silver to their reserves as a way to protect themselves against a weaker dollar. Whales hide behind LLCs, hard-to-understand ETF structures, and offshore accounts, making a lot of money while everyone else watches the price changes. It's a shadow accumulation that you can't see on Bloomberg tickers or hear on CNBC, but it's real money moving real metal. In the meantime, the policy landscape is shifting. The US is flirting with possible export bans, mining restrictions, and tariffs in an effort to keep silver in the system. But on the other side of the Pacific, Asian governments are making it easier to import silver, encouraging stacking, and even giving people money to buy it. It's not just trade, it's geopolitics in action. A secret battle over silver is going on. The East encourages stockpiling, the West limits flow, and retail dealers are the unwitting pawns. The supply chain war is another layer. Mining costs are going up because of high energy prices, a lack of workers, ESG rules, and environmental audits, all of which are slowing down the actual production of silver. Industrial demand is rising because of solar panels, electric vehicles, 5G electronics, and other high-tech uses, but production can't keep up. What happened? There wasn't enough structure. Futures contracts might still be able to trade freely, but the real-world supply shortage is getting worse, which could cause big price changes. It's not just about the metal, it's also about power. Silver, like gold, is used as a reserve hedge and a financial weapon in the global economic struggle. The East is quietly building up its reserves and real assets, while the West is creating currency at an unprecedented rate. That's a secret macro battle, and every dollar created without backing is a reason for the next silver squeeze. This isn't just a theory. The movement of silver between continents, along with central bank stacking, produces a hidden tension that could lead to a historic price leg. Now it gets really crazy. Picture all the money coming into ETFs in Asia, the rising premiums in Shanghai, and the disappearing COMEX stockpiles all happening at the same time as the US economy is weak. Any kind of shock, like a mistake by the Fed, a US export control, or a flare-up in geopolitics, might cause people all around the world to start buying things right away. And the best part? Western retail is still stuck in red days, leveraged situations, and paper promises, while the East quietly builds up its physical stack. There is a big but hidden threat to the US dollar. Silver is no longer just a commodity. It's a way to protect yourself from the dollar losing value. It's like a currency war in real life. East accumulating silver is a way to get out of fiat and get ready for a systemic risk that the West won't admit exists. Every bar that moves offshore chips away at the dollar's global monopoly, as central banks and whales get ready for the moment of truth. Imagine this. Silver flowing east, premiums rising, COMEX stockpiles falling, and retail stuck in margin calls. Futures contracts act like everything is normal, but the real market is global, tangible, and getting more and more hostile to the way things are now. Every investor who buys ETFs and every retail trader who buys dips is unintentionally helping to change the way the economy works, which could change the way silver prices have been in the past. And the cliffhanger is brutal. If East finishes stacking and Western supplies are drained, a single catalyst, policy shift, Fed move, or geopolitical event could ignite silver across every market simultaneously, propelling prices to levels retail has only dreamed of. One action, one trigger, and everything is different. The stage is set. The East stacks, the West prints, output slows down, demand goes up, and the hidden accumulation reaches a tipping point. When the domino falls, it won't just be a rally, it will be a worldwide surge in silver prices that will hurt latecomers, wipe out leveraged traders, and put actual holders in charge. And then, Part 4 will show you the big picture gloom underlying this buildup, the Fed's trap, and why self-custody might be your only way out. Because the pile of debt isn't going to wait for anyone. The US has $38 trillion in debt, Japan's bonds are trading at negative yields, and the world's debt has grown to an unreasonable level. People are getting out of paper assets because they see banks and ETFs falling apart because of hidden leverage. Silver and gold aren't just metals anymore. They're the last thing you can do to protect yourself from a system that is falling apart. Every day that goes by and every dollar that is printed brings this problem closer to the edge. And here's the kicker. The Fed's printing press is working harder than ever. A perfect storm has formed because of aggressive liquidity injections, very low returns, and the false sense of stability. The real returns are bad. Your cash loses value every hour, bonds are a trap, and stocks are rigged by central bank backing. Smart money is speeding up the accumulation of silver by discreetly accumulating actual ounces, while retail investors chase short-term surges in ETFs. The funny thing is, the Federal Reserve is the same institution that punishes them and also makes the next surge in precious metals happen. Now put the pieces together. Inflation hasn't gone away. It's only resting, ready to come back with a bang. The Fed has to put off raising rates if there is an unexpected bounce. This keeps yields low, leverage cheap, and metals strong. Every statement by the Fed, every CPI print, and every bond sale is now assigned to buy more actual silver. Retail traders who are trying to buy cheap SLV shares are easy targets, while institutional investors quietly turn paper into metal. Most people don't see the trap, but it's clear. ETFs float leverage over non-existent real assets, central banks quietly stockpile, and retail ignorance promotes panic selling. You thought a peak of $121 per ounce was scary. Try to see your leveraged holdings going away while the real owners move a lot of silver out of sight. Margin calls, forced liquidations, and terror campaigns in the media make sure that the weak are pushed out and the strong build up. This is the moment that most people miss. The next move isn't gradual. It's driven by physical structures and can't be stopped. East keeps stacking, West keeps printing, and stocks keep getting smaller. Because of these things coming together, a rally is not just possible, it's going to happen. If the current East-West flows keep up and COMEX stays under pressure, analysts say that prices could reach $150 to $180 an ounce in the next 6 to 12 months. The crazy changes we've seen? They are only the first course. Retail traders need to stop following the hype and find the real accumulation zones. Don't worry about daily charts, Twitter FOMO, or social media terror. Look for support bands in COMEX withdrawals, Shanghai premiums, and ETF redemptions. These are the real battlefields where you can get metal before the next blast. And here's the last warning. Don't keep your silver in paper form. ETFs can be stopped, leveraged positions can blow up, and banks can stop people from taking money out. Self-custody is no longer a choice, it's a matter of life and death. Put physical silver in a stack, lock it up, and keep an eye on what they can't touch. Every ounce you own is independence from a system that is set up to work against you. They control the story, the panic, and the price, but they can't change the silver in your hand. Every headline that tries to trick you, every forced sale, and every margin call is just noise. The truth is real, heavy, and valuable. It is waiting for those who are patient, knowledgeable, and brave. Picture this. The COMEX vaults are empty, Shanghai premiums are rising, retail traders are stuck in the negative, whales and central banks are quietly holding, and a global rally is about to wipe out weak hands and reward those who are ready. This is the big picture dread scenario that has turned into an opportunity. If you ignore it, you'll be sorry. If you participate sensibly, you'll benefit. So stack, hedge, and take charge now. When the domino falls, the system will speed up silver prices beyond what most people can imagine. This isn't just a theory, it's already happening. Physical scarcity, macro debt, manipulation by the Fed, and stacking of world geopolitics are all coming together. It's easy to get out of leveraged paper traps, take care of your own silver, and own the actual thing before it blows up. And don't forget, they can change everything else: charts, ETFs, futures, sentiment, but they can't print your silver, take your bars, or erase what you literally own. That's the last line of defense, the last act of resistance, and the only thing you can be sure of in a system that takes advantage of people who don't know what's going on. Hey, this isn't a practice. The mess you've been seeing, the drops, the rises, and the headlines that scream panic, that's when you can wear a mask. Every second you sit on cash or every ounce of silver you leave in an ETF or a broker's vault, you give someone else the upper hand. To do this, you have to leave the banks, lower your debt, stack real silver, and keep it safe yourself. Don't wait until the cost goes up to $150. At that point, the weak hands will be gone and the smart money will have already made their moves. Talk to your local dealers, check out the vaults, and start building your stack right away. Watch out for Shanghai premiums, COMEX withdrawals, and ETF redemption periods. These are the real signs that the news won't tell you about. What will you do first? Stack, keep it yourself, or chase the paper? Please tell us in the comments. If you know someone who is still betting on red days, tell them to wake up before it's too late. They can control the story, the fear, and the price, but they can't take the silver out of your hand, your move, your freedom, and your stack. Don't end up with nothing.